All right, we got just over 2 minutes until we're gonna get started. If you're in the chat, you're already waiting along these last 2 minutes. Feel free to check in. I'd love to give everyone a shout out. I love when people are tuning in on Sunday nights and joining us for the little hour show we put together for you guys as we go through and review everything as we head into the upcoming week in the market. But 2 more minutes and then we will fully get started. Prinzmeister in the Twitch chat, how we doing? Glad to see you. Glad to see you tuning in. And for whatever reason, I don't think the chat. I use this software that lets me stream on Twitch and YouTube at the same time, and normally it gives me like a chat window so I could see both of them at the same time. But unfortunately, I can't, and I don't. I think for some reason, normally in the bottom right of the screen we have the chat pop up, but I think that might be disabled right now. I was debating restarting it to try to get that to work, but we got 20 seconds left. I'll try to call out comments as I see them. I'm trying to keep up on my phone a little bit, but hopefully that doesn't take away too much from the viewing experience. And shout out to Dashio checking in the Twitch chat as well. Appreciate you guys. All right, so that is going to be the timer. We are going to get into it. Welcome back to another weekly edition of our Hourglass Trader trade ideas and more. So what does that more mean? I don't really know. It changes every week. But we're going to kick this off the way that we always kick it off. We're going to quickly recap what we did last week. We had a pretty crazy week in the market, so there's definitely a lot to talk about and definitely a lot to keep in mind and take into consideration as we head into this upcoming week. So hopefully we're going to be able to hit on all of that as we kick off this stream tonight. So last week, first things first, top of the list, the S&P 500 took a pretty big dip towards the end of the week. That was ignited a little bit on Wednesday when Jerome Powell, chairman of the Fed, spoke, and they talked a little bit about the fact that they were considering raising federal interest rates at the end of or at least before 2023, maybe end of 2022. And obviously the market never likes it when rates are going to be raised, so they did not react positively to that. And then the market was driven even further on Friday when he made some comments that they were considering tapering. And shout out to JWP806 in the Twitch chat. Appreciate you checking in with us. But long story short, interest rates are going to come back up. They're at all-time lows, which is good for the market because cash is cheap, which means growth is easier for companies. That is, I guess, the quick summary of why that is the way it is. But what that means for us is we need to be incredibly cautious moving forward. And you could already see 2.21% weekly dip. I could quickly pull this up in our summary when we look at the S&P 500 chart. Right, this flat line here is for this week, so ignore this. This dot to this dot was the movement last week. So I guess one of the bigger weekly drops that we've seen in the market so far this year. But, taking that with a grain of salt, because in general, over the last, 6 months, even the last, year, we've pretty much been in a straight line up. So, the quote unquote big dips really aren't that big in the scheme of things. So that's also something that's pretty important to keep in mind. But with that said, our strategy is built to outperform. We just got we've got someone saying they can't hear us. If you guys can hear me, let me know. Let me know in the chat. Let me know if you can hear me, and we can keep moving forward. And shout out to Casanova for the follow. Anyone can let me know if they can hear me. Perfect. We guys yeah, it looks like my mic's working. Dashia says they can hear me. More for can hear me. More for, how's it going? Yeah, Casanova, maybe it might be something on your side. I think it sometimes it automatically defaults to being muted or something like that. Maybe refresh it if it's not working. If it's not working on Twitch, maybe check us over on the YouTube stream as well. So we got a couple options in case you guys are having technical difficulties on your side. But let's keep it rolling. Talking a little bit about the fact that the market's pulling back. It was a decent dip, but obviously things can get a lot worse, and we're going to talk about that a little bit later in the stream. But as far as what we did, the strategy that we use is built to outperform in situations like this. So, we love seeing stuff like this. We kind of like it. We it's like a sick kind of enjoyment seeing the market pull back, because we love to sell these puts, and we love when there's good premium on the puts, and that happens when the market pulls back a little bit. And the strategy we use, there's a built-in cushion to our trades, and as you can see, we returned a 2.85% return this week, which outperformed by over 5%, and that is an awesome return considering this is one of the worst weeks that the market has had all year. So I guess going on a row-by-row basis to quickly run through here, because like I've mentioned lately, we definitely want to try to get some more analysis than recap on these streams, so we're going to try to move through this really quickly. UWMC expired, worthless for us. That one shot up above 9. That's been a really good play for us. And it also was the end of our GHIV/UWMC. We own GHIV as the ticker of the SPAC that turned into UWMC. So that's how long we've been playing this one for. We got in on December 9th, 2020. It's been all over the place. We've had some ups. We've had some downs. We started when the stock was at 1084. It finished at 952 on at the end of the day last Friday, which means that the stock, in the time that we played it over these 6 months, decreased 12.18%. But we were still able to pull a return of just over $11,000, which is 49.24% return on capital that we had invested. And while this can get a little bit convoluted as you move down, I mean, for those of you who have been following us, we followed the typical HT wheel strategy to a T, where we started off, I think we started in shares to sell covered calls, as you can see right here, but kept selling covered calls, kept chipping away at that basis. When it dipped a little bit early, we've sold some puts to further lower that basis, and that is the plan that we followed for the last 6 months that got us an awesome return. And it's just a testament to, so often we say vaguely like, oh, you find a good stock, you follow the strategy, things are going to look okay. This is such a good example, textbook example of what happens if you find a good stock with good fundamentals that offers good premium. You could still handle this big of a drop and still pull a really nice 50% return on capital in just 6 months, which annualizes, of course, to 114.48%. And again, I might sound like a broken record when I try to emphasize how effective this strategy is in situations like this. But, if you could put yourself in a position where you're effectively doubling your money on a bullish position when the stock drops double digits on you, percentage-wise, that's going to be some pretty good stuff. So we're really happy about the way that one turned out. One more tab over, back to the weekly tracker. ICLN, that one is just sitting in the very bottom of our portfolio. We are going to let that one be. But as you can see right here, we're just continuing to sell covered calls to chip away at it. Super boring, but one that I'm maybe stubbornly determined to make a profit on overall. PSTH is one. Again, we got in. We got in above 30, and we've got a basis. I think our break-even price, I could give you the exact number really quickly. Break-even is down to $23.46, and that's when we got into this play with it starting off at $31.49, and that was back in February. So in just 4 months, this thing's dropped almost 30% on us, and we're still in line to break even on this one if it gets back up to $23.46. So that's one week-to-week basis. Going to keep selling those covered calls on that. Next on the list, LOTZ. This play was awesome for us. We got in at about $4 a pop. We sold some 5-strike covered calls and said, hey, if this thing bounces back up, we'd be thrilled. And it did bounce back up. It bounced back up a ton, finishing 555 on Friday, but it got up to 7 or 8, I think, in the last couple of weeks. So there was a pretty big recovery spike. And as you can see, we ended up getting a 55.55% return on capital in a month, which is an enormous number, illustrated by the fact that this is a 108,000% annualized return. So These kind of numbers with, again, that lower level of risk, right? We had it was a 402 break even when we initially entered, but we added a strangle to it with the 5 strike put and the 15 strike call, which brought our break even up a little bit. But the fact that we could enter into a play at 4, get a solid basis around 4, and then we opened this when it was trading around 6 or 7. So we were able, while we never want to increase our break even price, we figured bumping it up to 430 wasn't too bad of a proposition when the stock was trading at $6 or $7. So that worked out really nicely for us. Moving back to the weekly review. Let's go. CRSR. Okay, we had a very good week. This is the one thing that went against us. So we're going to talk about this really quickly because this is one we're going to be holding on to for another month, and you'll probably see us talking a little bit about. So let's get into that one a little bit. We've got the CRSR trade breakout. So off the bat, we sold these 35 strike puts, right? And we did this when it was trading at 35.50 back on June 14th, which is what? That was, last Monday. So we put ourselves in a position where we got into a 1 week play where, it was at 35.50 as long as it didn't drop, $3.50, which is a decent percent decrease in a week. We were going to hit a max profit of 1770, which is a really, really nice return for 1 week, especially on a stock like this. So obviously, the reason we're talking about this right now and why we're in a position where we have to wheel it is it went way further than 35. Unfortunately, dropped all the way to 31.93 as of market close on Friday. Now you can see our break-even track over here. This is something really important that I like to highlight because the whole idea behind our strategy is the fact that, look, we're not going to win every single play, but even the ones that we lose, this right here is what's going to be saving us. So on June 14th, we jumped in when the stock was at 38.5. We sold 35 strike puts for $1.18, and we know that the break-even price on those is 35, the strike, minus the premium of $1.18, giving us an initial break-even price of 33.82. So that's a pretty big reduction in cost basis off the bat. So we were super happy to enter into a play like that. And then the stock dropped pretty heavily. So what we did was we sold some 37.5 strike calls to really turn this into more of a strangle. So if it jumped back up, we were going to get this 1700 in profit. But if it didn't, we were able to lower our break even by 30 more cents. 30 more cents in the scheme of things isn't that big of a deal. So if you didn't do that as part of your play, no worries, but it's one of those things where I always like to be a little bit more safe as far as my break-even price. So that knocked it from 33.82 down to 33.52. And then from there, we took assignment and sold July 16th, 35 strike calls. So what that means now is our break-even price. We sold these for $1.80 of premium, meaning our break-even price is going to decrease by $1.80. So our new break-even price heading into July is going to be $31.72, which represents a 17.61% reduction from the initial price that we got into. And again, this is all in 5 days work. So this is really a great illustration of the value that selling premium provides you with as far as the downside on your trades is concerned. So we talk so much about the downside. We know that our break-even price is 31.72, but now the question is, what happens? What's our upside looking like? So we sold 35 strike calls, meaning that, if CRSR goes back above 35, we're going to have to dump these shares for $35 a pop. So what does that look like? And the answer is we'll get roughly a $5,000 profit. So if on July 16th, Corsair is at 35 or higher, we'd be in a situation where it's decreased 9% on us in a month, which is a pretty big drop objectively for a stock. And despite that 9% decrease, we're in a situation where we've pulled a 21% return in just a month, again, despite that decrease. And again, over that short time frame of just over a month, that's an 821% annualized return. And that really drives what we're trying to get at with the strategy that we're running here, right? We want to, one, protect our downside no matter what. The safety that this strategy provides is the number one goal or consideration that we look at when we're entering into a trade. But two, we've put ourselves where, we're in step 2 of this trade. Step 1 is if this thing, finished at zero, and we made $1,700 of profit and, went on to the next week like nothing ever happened. We're in step 2 of this trade now, but the idea is that despite being in step 2 because something went wrong, we're still in a situation where if it jumps back up to 35, we're hitting an awesome, awesome, awesome monthly return. And if you keep putting yourself in positions like that, you're going to keep winning. So let me put this back to the formula to calculate the current price so this updates properly. But again, at 31.93, this calculates it as if, these expire worthless. If Corsair doesn't move between now and July 16th, we're still making some money despite a 17% decrease in the stock. And again, we mentioned in our HT wheel strategy, sometimes we like to sell cash secured puts to create a covered strangle. We're not going to do that yet. I think if Corsair breaks below 31 into the 30 range is when we might throw a little more capital at this play and enter into that. But for now, we're going to be patient because, the best way in my mind that we could handle this play and view this play is if, nothing happens to the stock between now and July. So if Corsair stays completely flat between now and July 16th, what's the result? We're going to be making money. So that is what we're going to do. We're going to stay put at this price level. If it drops down below 31, gets closer to 30, we're going to consider selling some more puts. But, we'll just keep an eye on a day-to-day and week-to-week basis. And then more likely than not, we're going to be checking back in on July 16th. So that's the plan with that one. Heading forward, Zillow was an awesome one. Expired really quickly we closed that one really early, I should say. I think on Monday or Tuesday for a 560 gain on those 100 strike puts. And shout out to it's Air Patrick for the follow in the Twitch comment saying, can we do a catch up on what we're currently talking about? So right now we're doing a quick recap of the week that we just had. We pulled a 2.85% return, $4,000 despite a 2.21% drop in the market, which is an awesome, awesome, awesome performance because, it's easy to make money when the market's going up. The most valuable thing you could be doing from a trading perspective is treading water or even making money when the market's going down. And that's what we were able to accomplish this week. So to answer that question, we're quickly doing a recap of what we did last week before we get into next week, which we've got that down here. And we're going to talk a little bit about what we're seeing in the market, maybe run a quick scan or two and look at what we see in the upcoming week. But to round these out, the last few plays we had, DraftKings was an awesome one because we could actually pull up Thinkorswim right now and talk a little bit about that really quickly. Let's pull up the DraftKings. They had a short report come out about them. I think it was maybe Wednesday or Thursday. It was whatever it is, right? 6:15. I don't remember what 6:15 was. Tuesday? It looks like, but basically in the pre-market session, it dropped from about 50 to 44. And DraftKings is one we've had our eye on because we like to talk so much about macro trends, industries that we like to have our money in the long term. And gambling kind of fits the bill there. I think, gambling is one of those areas that's only going to get more legal as time passes. So I think that's a great place to be invested in the long haul. But what we did here is, as we also talked a little bit about earlier, when you see sharp drops like this, premium on puts is unbelievable. So we found ourselves in a situation where we could sell 42 strike puts that expired on Friday right here for 88 cents a pop. And to me, that was a home run. So 42 strike puts for 88 cents means that your break-even price is going to be 41.12. And 41.12 on this chart, you can't even see it. It's so low. We have to zoom out on the y-axis. Our break-even price would be right here. So while pre-market, that might have seemed like a really big drop on DraftKings from 51 to 44 at the low, 44.65 at the low. Being able to set up a play that paid out a really nice return with the break-even price right around here honestly seemed like a no-brainer to us. And within a couple hours, it had already rebounded up near the 50 level. And that's when we closed these. We sold 20 off the bat, so that's why you see 10 here and 10 there. We closed these for 57 just to lock in a little profit, and then we let the rest ride. And those cruised to profit, as you could see. It never even got close to that 41.12 break-even price on that trade. So we were super happy with that one. Always a great opportunity when there are big pre-market drops on strong names to sell some decently far out of the money puts and take advantage of the IV crush that comes along with those. And then, that takes us to my favorite play that we had this week, which was ORPH July 16th 5-strike puts. We were able to sell these things for 60 cents a pop. And again, as we know, with that discussion of break-even price in stocks, a 5-strike put, when you get 60 cents a premium, means that your break-even price on that is going to be $4.40. So let's pop up the chart to ORPH and see where $4.40 is. And again, we did this back on, earlier in the week. So it was right around here, I think I want to say the day was the 16th, I think is when we did this trade. And in fact, we don't need to be in on it. But right around here, we saw those puts. We saw that the stock was trading just above $10 a share and said, hey, if we could enter a trade where the stock is currently above $10 a share, but we have a break-even price of, $4.40, I think that's a really good value proposition. Now, the reason the break-even price was $4.40 and we were able to get so much premium on those 5-strike puts in the first place is because it's a biotech company and that they had some, I think, trial results that were coming out. And you can see those did come out on Friday when there was a big drop from 15 down to 5 at the low before it settled at 723 at the end of the day. But yeah, there we go. Quick question to answer that one, Air Patrick. So on DraftKings puts, would you buy shares at open and then sell the puts? And the answer is no. You don't need shares to sell cash secured puts. So when you think about it, what is a put? When you buy a put, you have the option to sell someone shares. That means when you sell someone a put, someone has the option to sell you shares. So what happens with the 42 strike put is either it expires above 42, it expires worthless, and we keep every dollar on that put that we sold, or it finishes below and someone exercises their right to sell us shares. So there are really two things that could happen, right? It finishes above 42, expires worthless, or it finishes below 42, someone exercises their right to sell me shares, and I now have 100 shares at, $42 a piece, which is great because at the beginning of the day, DraftKings was at 44, 45. So even if I were in a position where I was signed, I'd be getting a $3 discount on the stock from where it was when the market opened. And that's why we love selling cash secured puts so much. And for those of you who might be watching and either haven't had a lot of experience with options or only have had experience buying options, I think our YouTube channel is a great place to start to learn some of these option selling strategies, because what happens is, obviously options are decaying assets. So when you buy those, I like to compare it a lot to playing the lottery. Your odds aren't high. I mean, every now and then you could hit a big return, but in the long run, you're going to be losing money. Whereas when you sell options, and as you can see by the chart that we have right here for our performance on the year plotted against the S&P 500, we have some weeks, right, where, we had some big losses, meaning the person who bought the option from us was a big winner. But in general, the long-term trend is that we're going to be moving up into the right because we're putting ourselves in positions that have high expected values, and we're locking in good returns that compound week after week to make some really solid yearly returns. So that is the rationalization behind the option selling strategies that we run and kind of how that DraftKings play worked. But, back to this really quickly, we sold these 5-strike puts for 60 cents a pop. And we sold how many? We sold a lot of these, to be completely transparent. We sold 50 of them, meaning that, if it finished above 5 come July 16th, we were going to make $3,000. But the great part about this was it leveled off a little bit around this level here. So despite the fact that these options that we sold expired over a month from the day that or exactly a month from the day that we sold them, half of the value actually disappeared because implied volatility was through the roof. And, to illustrate this point of IV crush and selling options when IV is high and premium is high, let me pull up the implied volatility line so you could see exactly what's happening here. So there you have it. It spiked up. This is right around when we sold the options. Spiked up right around here at the beginning of the day on June 16th. And from there, despite the fact that the stock ran up a ton, implied volatility actually pulled back a little bit. And because of that pullback in implied volatility, we were able to buy these puts back for half of their value, meaning we got a $1,500 gain in, the span of a few hours. So that was phenomenal for us, and we were super, super happy with that trade because it's always, we like to have a plan going into the week, but at the same time, it's also really nice to pull off some of these intraday trades where we see opportunity like this right here, where we match up implied volatility and compare that against option premium, compare that to our potential outcomes on a trade. So that's something that we really enjoy doing on a week-to-week basis. So we were super happy to have that $1,500 of profit, which was pretty low stress for us and a pretty quick turnaround. And I know we had a bunch of people in our Discord server as well who were able to make some profit on that one as well. But yeah, then ATOS, AHT, pretty low-key, boring plays where we collected a little bit of premium on those. And then our SPX hedge worked again. So I think we've hit like almost 10 of those in a row. And we don't currently have one open. It's too bad we don't, because the market looks like it's pulling back. But that is what I tried to make a quick recap of the week turn into like a 25 minute recap. But, there were some things in there and some points that I felt were important to make in the context of what we're doing and what we saw in our strategy and how we managed our plays during the week. Because, it might have seemed a little bit straightforward with what we were doing when we explain it like that really quickly on the stream. But, the market was moving up and down all over the place. So it wasn't exactly the easiest week from a trading perspective to navigate. So let's scroll down to this upcoming week. And here is what we're sitting on. And the reason we've already got some profit here, right, is because when I opened plays last week that applied to this week, I get kind of lazy and I put them down here. So last week we opened UWMC longer dated puts. We sold some SoFi longer dated puts. And then we had our covered calls on Corsair. We sold Friday for $1.80, but we included those in this week because they're for the upcoming period. So same with Wish. We sold some of those last week. And then VGAC, which is a SPAC that merged with 23andMe. We had that one going last week and forgot to include it, so we're going to give ourselves that profit down here. But yeah, this is what we are currently holding. It's not obviously the big laundry list. I mean, even this isn't that long, but you scroll up a bit through our weekly tracker and you get the idea of how many plays that we normally are holding on a week-to-week basis. So, I mean, it normally takes up the page right here. So the great part about the position we're in right now is we've got a good bit of firepower on the sidelines. People always say, oh, I've got, this much money left in my account. What should I invest in? And to answer that, cash is a position too. You don't need to have 100% of your money in plays 100% of the time. And, when I say cash is an investment, when your account is strictly cash and the market pulls back 2.21%, there you go. You're already outperforming from no action there at all. So the amount of cash that we currently have on the sidelines compared to what's been going on in the market is very encouraging for where we stand. We are, we're kind of hoping for a red Monday to give ourselves a really nice buying opportunity. Looks like futures are down 0.26%, so we're on our way to potentially a red open on Monday. So that's something we want to keep an eye on. We're going to be very conservative again because, we talk about this a lot, but here's the chart for the S&P 500. Yeah, over the past 5 days, pretty. And if you look at it in the context of the last 10 days, pretty big dip. If you look at it in the context of the last 20 days, we're below where we were a month ago, but a decent runoff. However, when you back it up to a year, this is not, and I can't emphasize that enough. I feel like I say this every week. So if you're tired of me making this point, at least hopefully I've hammered it home for you that despite how big of a drop last week might have felt, in the scheme of things, it is not that big of a drop at all. So it is important to, not go all in on the first dip that you see, kind of strategically deploy cash throughout the week. And it's important to follow the tenets of our HT wheel strategy as far as position sizing is concerned, making sure that, you don't allocate 100% of the capital to the play at once, maybe scaling at 50 or 75% of the capital that you're comfortable with investing off the bat, so that if the market does continue to, keep turning downwards like this, you'll have a little bit of recourse there and some more favorable break-even prices on your trades. But I mean, if we look at the context of the last year, right, we had a pullback back in September from 358 down to 323. We had one in October from 354 down to 325. And, a similar pullback would put us right in this 390, 380 range. So that is something that I'm keeping an eye on. And, if we do dip down to here in the near future, that is when I really will start getting aggressive with strikes and collateral deployed. But for now, I think I've got about half my buying power free. I'm in no hurry to use it right now. We've already got plays that are ongoing that are, in theory impacted by the overall market. So we're just going to keep rolling along with those and keep our eyes peeled for when volatility spikes, as you can see right here, which will increase option selling opportunities and give us some good looks at entries for new positions. So I think, maybe a little bit of a spoiler here. We're probably not going to have too big of a conclusion on, this is what I'm going to open Monday morning. This is what I'm going to hold all week. But I think we definitely could have a good idea of stocks to keep an eye on. If this drops to a certain level, we might want to get in on it. Just be patient. It's important not to blow all your money right off the bat Monday morning. It is super important to be strategic and pick our spots here. We've got a question in the YouTube chat about Fubo and Workhorse. So we could talk about those really quickly before jumping into the old analysis. Fubo right here. This is the 1-year chart. As you can see, right around the $8, $9, $10 range is where it traded for so long. The streaming company then had a bit of a short squeeze towards the end of 2020 where it peaked at 62, dropped back down to 27, and then had kind of a part two back in February before coming all the way back down below 20, up to where it is now settled at about 30. So for me, this one's a little bit scary because, about a month ago, May 11th, the date of this candle, this thing was pushing $15 a share, and it's basically doubled from there. So these short increases in price are a little bit scary because we always like to think of the downside potential on our trades. And with our strategy, admittedly, you can get into a little bit of hot water if the price of the stock starts dropping faster than you could be decreasing your break-even price. So that's something that we definitely want to try to avoid. And when you have a stock that's run from 15 up to 30 in 1 month, you're at a much greater risk of that kind of a pullback than if you were playing the stock back in this time frame. So strictly from a chart perspective, this is one I personally would stay away from. I do think it is a little bit overvalued too in the context of other companies in the streaming market, especially when you put it up against, a Roku, which is, in my opinion, similarly overvalued. But, I say all the time, that's just my opinion. We don't have to agree on the stock analysis 100% of the time. I think it's perfectly acceptable for us to have differing opinions on stocks and, which direction things are going to move in. But I do think the one thing that is important that we agree on is the strategies that we use to play them. So, this just doesn't set up well for our strategy. You still are getting let me pull up the ROR right here, return on risk. You can drop down to 26, 25 and still get about a 1% return on risk a week. You go at the money, you get about 3 to 4% a week, which is a great number. But, with that $1.26 a premium, if you sell right at the money, your break even is going to be about $27.75, which is here on the chart. And for 1 week's time, it doesn't look too bad, but for 1 week's time, let's take a look back at the 10 days. Your break even will be $27.75 right here. As you can see, it broke below that, just a few days prior. So definitely one where you are potentially at risk to have that breach. So not my favorite as far as the setup in the context of our strategy. Workhorse is another one. I think it's probably going to have a pretty damn similar chart. They were a company, a big EV company that had a lot of speculation about getting a contract to provide the United States Postal Service with electric vehicles. And this is the day that they announced that they were going to give that contract to Oshkosh, I think is what the company was called. Not the baby clothing company, but apparently there's another electric vehicle company called Oshkosh, and it dropped from 32 down to 15 before, again, a month ago. Yeah. So I guess maybe my first little bit of intuition was dead on here, right? May 14th, this thing bottomed out at about $7. And look, a month later, we've doubled in price. So it's one of those things where if you think, 12 or 13 right here, because it looks like you could find some support or resistance in that range. Just it chopped there for a little bit of time. Looks like during the month of April, the month back into March is when it was trading in that range. So you could potentially expect a little bit of support in this area. But, I'm not a huge fan of the company after they missed out on that contract. But again, we don't have to agree on every single stock conclusion. But if you did want to sell an option on this is probably the range I would look to have your break even in off the bat. So let's take a look at the chain and see if we could get ourselves that kind of a break even price. And you definitely can, right? If you sell a 13 strike put for the upcoming week, that's 25 cents a premium. That's a 2% return on capital risk off the bat right there. And that's a really, really, really solid weekly return. If you're pulling 2% a week, you're going to over double your money over the course of a year. So 13 strike put would put your break even at about $12.75, which if we zoom into the last 10 days is going to be right about here on the chart. And yeah, honestly, from a short-term perspective, not too bad of a of a break-even price. Now again, I do think it's so important to back out and look at the overall chart to see where not just your short-term support could be, but also the long-term support, where it does have a similar setup to Fubo in the sense that it's doubled over the past month. So I do see a little bit of risk there. But at the same time, there is a decent trade-off at that 12, 13 level if that's a price that you're comfortable being in on the stock at. So, if that is the conclusion you're comfortable with, absolutely let that one rip. So back to what we're going in on this week. UWMC is an interesting one right here because we'd been playing this on a week-to-week basis, and this is one that I want to talk about really quickly because a lot of these trades, you might look at an ROR, especially for these bigger stocks, right? You might look at like an Apple and say, I want to go sell a 127 put, but a 0.41% return a week isn't very enticing. But that's where the concept of not just return on risk, but return on capital steps in. We could pull this up right here. Return on capital is essentially the return, but instead of using the max risk as the denominator, it uses the buying power that the play ties up as denominator. So if you have a play where normally it would be like $10,000 for it to be cash secured fully, that would be your denominator for return on risk. Return on capital takes margin buying privileges into account. So if they only required 33% of that, and you only needed $3,000 of collateral, roughly, you essentially would multiply your return on risk by 3. So as you can see, Apple has a little bit lower maintenance requirements. So while you might see something like, you might see a 126 strike put and say, a 0.3% return on capital really isn't good at all. Well, here's the deal. If you factor that into a return on capital percent basis, and I think I accidentally said return on capital the first time, whatever. If you have a 0.3% return on risk, you say that's not that much. If you look at it from return on capital perspective with the margin privileges that your broker affords you, that 1.74% return, was coming up against that 2% return mark that if you pull weekly, you're over doubling your money every year. So that's one where you could use these bigger names, set up some hypothetically safer trades to still generate some really nice weekly returns. And again, this number right here is also a super interesting one to look at in Thinkorswim. It's the implied move during the week. So basically, there's a complicated options formula that I will not be explaining on the live stream that takes the prices of the options in order to give you an implied move during the week. Basically saying, hey, this level of premium at this strike and this level of premium at this strike, and looking at all the different strikes implies that the market expects this big of a move. And over the next week, it implies a $1.22 move. So, if you were going to sell something like at 126, you're over 2 implied moves away from where the market expects it to be. And that's a really nice value from an expected value perspective, back in the context of putting ourselves in these high percentage trades that we like to do. So we've got JP saying in the YouTube chat saying, how far out do we usually like to look back for a week time frame? And that's a good question. When you look at Workhorse, right, and we did look at that 10-day chart and say, okay, it's above your break-even price, and keeping in mind that, hey, your option is only going to last 5 days if you sell a weekly at 13 out of 13 strikes. So what are we really worried 10 days back? And again, I think the answer is just like that conversation we had a little bit earlier, is we always want to be mindful of the downside. Now, I guess from a perspective of looking at this and saying, in the next 5 days, do I think this thing's going to go below 13? Absolutely not. But what I think is important to look at is, if shit does kind of hit the fan for you in the next 5 days, how bad can it get? And usually that's some sort of retracement down to a previous level of support, whether it's 12.83 or down to this gap down to about $10 a share, or even if it gets down to 8.18. And not that I'm saying I think it's going to get that low, but you want to have those numbers in the back of your head so you have some sort of plan in case things get really, really bad for you. So again, I definitely don't think it'll even be below 13 this week, but if it does, as someone who would be entering that trade, if that's you, you definitely need to know the possibilities that, hey, this is probably a level of support right here. If it breaks through there, this is a level of support. And those are important to know because, as I mentioned also earlier, you only really want to start with about 50, 60, 70% of the total capital that you're comfortable putting in the trade, right? So if you wanted to invest $10,000 in a workhorse and you sold $5,000 of collateral worth of cash secured puts, and it starts dropping, you might say, oh, I'm panicking a little bit because it's already below 14. Having zoomed out that chart and knowing that, hey, wait a minute, there's some support here at the 12 to 13 area might help you with the patience. And if it, then breaks below 12 or 13, that's when you could say, okay, this is now where I'm going to deploy the rest of my capital and sell some more cash secured puts to lower my break even price. So that is why we look at that. And honestly, I'll back it up to 180 if it's a stock that's been around a little longer. I'll even back it up to a year. But, I don't think there's too much on the workhorse chart that, this will scare the shit out of you if you back it up to the 3-year, because this thing was trading below $1 for the longest time. But, that's typically why I start to, I start small on the chart and then slowly zoom out to understand, near-term possibilities and then, longer-term areas of support if things start going a little bit crazy. But hopefully that answered your question. Popping back over to our weekly tracker, UWMC is, that's right, we were having that conversation about margin privileges. UWMC is a super interesting one, right? Because if you want to sell like if you want to sell a 7-strike put, there's no premium right now. But if you wanted to sell a 9-strike put for the upcoming month and you wanted to sell, 10 of these, you would have a $500 return, and you could see the margin privileges right here, right? Normally, your max loss is the amount of capital you have at risk, so that would be $8,500. But it only requires just over a third of that. It only requires $326. So normally your return would be 500 divided by 8,500. So it'd be a 5.8% return on capital. And that's roughly what it has right here. It's using 52 cents instead of 50 for this calculation. But our return on capital, right, is 500 divided by the actual buying power effect of 32.63. Oops, should probably hit the divide button. So really your return on capital, and this assumes 10% margin requirements. So that's not right. We know it's about 33%. But thanks to this leverage and buying power margin, relief that your broker offers you, you go from that 6.19% return on risk and you triple it. So that puts you in a really nice position. But now the question is, you might see my play here and say, okay, that looks pretty nice for July. Why did I feel the need to go out to December? And this is where the numbers get pretty interesting from a margin buying power perspective. So we know that we could have gotten a 15% return on capital with an $8.50 break-even price at a 9-strike for the upcoming July 16th expiry, right? Which is that 9-strike minus the 50 cents of premium, getting you down to about $8.50 a pop. So we could have had a 1-month time span where we had an $8.50 break-even price and a 15% return on capital. But it gets a little bit more interesting when you back it up a little bit and say, hey, let's take a look at December 17th. And something that was surprising to me is that December 17th is, only 6 months away from now. We are already halfway through the year. But, if you look at that similar 9-strike, you're getting 4 times the premium. So we know that the 50% or the 50 cent premium on the 9-strike for July will get you down to an $8.50 break even. $2 of premium on this will get you down to a $7 break even. Again, looking at the longer term trends, the lowest this thing's ever been was 625, and it was there for, a second. So 7, in my mind, over the next few months, the worst case scenario on this stock. So knowing that, you might say, okay, I'll enter this play where I could potentially have a $7 break even price and make a good bit of cash off it. So we'll call it $1.95. But you now get $19.50 of profit off what normally would be $7,000 of risk. So that would be 27% ROR, return on risk. You now get $19.50 of profit off of $32.63, which is a 60% return now in just 6 months. And again, that's a really nice play because your break even is 705, meaning you've got about 25% cushion on the downside. And if it stays above 9, you're putting yourself in a position where you have a return that annualizes to over 100%. But it gets a little bit more interesting when instead of a 9-strike put, you go a little bit further out of the money to this 7.5-strike put. So now we have a play here where there's $1,000 of profit for only $17.63 of collateral. So when we put that one into the calculator, if it comes back up on the screen for me here, $1,000 divided by 1763 is 56%. It's roughly the same. And I will say before this week, when this was above $10, this number right here was even lower. So maybe if we go look at the 6 strike, we could find something kind of similar to what we had set up. And there you have it. This is super, super, super interesting because not only is your return on capital higher here, and we're going to pull the calculator up one more time. Come on. Where normally you would have that 8% return on risk, right? A $400 return divided by that 5,600 max loss. You now have a $400 return divided by $600 of collateral, which is a 66% return on capital, which is, again, is phenomenal. And not only is that a 66% return on capital, as you know, it's a similar level to what we had at 7.5 and 9. Your max profit level is now at anything above $6 a share, and your break-even price is $5.50 a share. So taking a look at that in the context of the chart, right? Your break-even price is at this price level for the next 6 months, and again, this is last March. So I mean, it would be a pretty big drop. And let me add the drawing really quickly here for the price level. It would be a pretty damn, I'm getting to the point of the stream where I start forgetting how to talk. It would be a pretty damn big drop between now and December, right? Over the next 6 months for it to get all the way down to $6. And again, even if it does get down to $6, you've still got a little bit of premium protecting you to right around this level being your break-even price. So even if, you know, doomsday happens and it drops this low, it's okay because you still have a barrier to catch you. This is max profit. This is break even right here. We've got J Marts. Shout out to J Marts checking back in the YouTube chat asking, will a broker's change of margin requirements, will they change the margin requirements after this play? So again, this is something to be super mindful of, right? Because you might see this play and say, okay, this is awesome. I'm just going to go ahead and try to get a 66% return on my account, right? But what could happen at any given point if the stock starts to drop is that this number could get a little bit bigger. So if you have like a $10,000 account and you do this play with all $10,000 of collateral, you know, if UWMC drops, one day your broker could say, you know what, it's getting a little bit too close. We're going to double this. And all of a sudden you have a play now that you've been holding that requires $20,000 of collateral when you only have $10,000. So because of that, and because of the, I guess, broker imposed risk of them increasing that buying power requirement, obviously this isn't something you want to come remotely close to going all in on with your account balance. So that's why this is something that is a smaller chunk of our portfolio, and we're just going to let this thing ride. And if, you know, the terrible situation we outlined does happen, it starts dropping and slowly they start to require more and more collateral, you know, we're okay holding a bunch of shares of this at, you know, 7.5 strike, right? Worst case scenario is we're assigned 50 times 100, we're assigned 5,000 shares at a 7.5 strike, meaning, you know, worst case scenario, this becomes a $37,000 position for us. That's still a small chunk of our account balance. And to be honest with you, we could probably even go in a little bit heavier. But as I mentioned, we like to start off with about 50, 60, 70% of the collateral that we're comfortable having it on the play. And that's what we've done right here. And if nothing happens to UWMC, this thing drops, or excuse me, stays flat, or doesn't even get down to 7.5, that'll be a $5,000 profit for us. So that's one that we're really happy with. That is the thought behind that trade, and why, especially with the uncertainty in the markets going forward, we might look to start opening some smaller long-term positions like this just to maximize some ROC percentages. Because again, you know, if the market takes a huge downturn, UWMC drops 20%, you know, people are going to be out there blowing up their accounts. But, you know, if UWMC drops 7.5%, we're still in max profit territory. So that's what that is another part of this strategy that is so appealing to me, that strategy of selling longer dated puts, which I might try to get into a little bit more. But those of you who follow closely enough and have been around for a while know that I'm also terrible at sitting on my hands because I enter so many trades on a week-to-week basis. But yeah, grand plan here, right, is that we get back to this discussion about implied volatility, and implied volatility running up a good bit. It was a little bit higher, obviously, back on June 7th, but this move is pretty crazy. We expect it to level off and volatility to get back down to around this level, which would almost cut the price of these in half. So our grand plan is in the next, month, 2 months. Hopefully we can close these for about 50 a pop and have a nice $3,000 profit, which with little stress and little effort. So that's the plan, right? We don't want to hold these until expiry. We want to cut them in the next month or two for hopefully 50% or more profits. And it's the same deal with SoFi, right? We sold these 12.5 strike puts a month later, January 2022, which almost feels weird to write that's a position I'm even in right now. But 12.5 strike with 1.52 premium means we've got roughly an $11 break-even price on SoFi, and that's a pretty damn good break-even price, especially if you look in the context of where it's been since the merger. Having a break-even price right around here is something I'm perfectly comfortable with. We could take a look at SoFi's options for that January and the reason why we went on this one, and you could see that these offer the return on capital here is a little bit funnier because, before with UWMC, obviously that one is a relatively safe high percentage play. We could see SoFi offering 1180 of max profit with only a 1255 buying power effect. That's a 94% return on capital, meaning that every dollar you put forth as collateral in this trade, again, assuming that the collateral doesn't change, you're going to double that money if it stays above 12.5. So as long as this thing doesn't drop 50% in the next 6 months, you're doubling the money you put in that trade. And I cannot emphasize enough, just how great of a value proposition that is. But at the same time, again, don't make it too significant of a percentage of your account, because then you could run into some issues if margin requirements start getting moved around and such. But, I already went on that spiel, so I will not digress too far from where we just were. But again, super short list. Let's quickly run through a scan to see what's going to be coming up this week. But I can already tell you with the volatility in the market, with how quickly the S&P 500 was dropping off at the back end of last week, this big red candle there, a lot of what we do this week is going to be on a day-to-day basis, and we're going to be looking for good entries, trying to be smart with our money here. And we can already see these are the futures right here, right? /ES, the S&P 500 futures. They're already down 0.35%. So we are down, continuing that move downwards. So, if for some reason this makes my computer a little bit slower, there we are. And we might see a little bit of a support right in this 4130 range, but that remains to be seen. All I can tell you right now is we're heading down. Volatility is heading upwards, but that's a good thing for us because we love that volatility because it breeds option premiums. We got a comment from Prinsmeister HT. If we have time, Prinsmeister, we've always got time for you. He'd be interested in getting our opinion on how to handle a covered call position with lumber liquidators in the upcoming week. So, let's take a look at lumber liquidators for you right there, Prinsmeister. And yeah, as you can see, very similar drop off. I don't know a thing about your cost basis in the stock or the strikes that you've been selling. So if you could throw those in the chat, that would be a little bit helpful. But I can give you quick run of what I would be looking at. Again, that 180-day chart is a good place that we like to start. There was a really solid point, and again, this is why we point out support and resistance points so often, because when they break through them, things could get a little bit rough. We could outline this here with a drawing that, actually probably better if I have a price level drawing right here. You see it, bottom out here, bottom out here, bottom out here, bottom out here. What happens when it doesn't bottom out at that level, right? It broke through that level pretty hard, last week, and it resulted in a pretty big drop after that. So that is why we look so closely at these areas of support and resistance, and that gives us a good idea of entries, exits, when to get out, when to get in, when to get out on a stock. Prince Meister saying he did not, cost basis around 21, been selling 23 each week. He didn't get any premiums last week because of the sharp drop. Not too big of a worry. I think a 21 cost basis is, at the very least manageable for something like this. Let's take a look at the year. Looks like you might find a little bit more support because it bottomed out here, right around the 20 area. So, I think maybe In the short term, playing around 20, and as you can see from the daily price action last Friday, it did get a decent little bounce off 20. So that hopefully is at least a little bit optimistic, but let's see what kind of premium you can get on your calls. Okay, this is perfect. Your cost base is around 21 bucks. You're in a position where like the stock has dropped, so number one priority for us should be to get our break-even price down and hopefully rescue the trade, and if not, get out with a profit. And that can be done pretty easily with these 21 strike calls that are going for about 25 cents a pop, right? So that would put your cost basis around 20.75. Obviously, if it ran up past 21, you'd miss out on those gains, but you'd have a situation where your cost basis was 25 cents lower than what it got called away for. So, not the worst thing in the world to get out with the 25-cent per share profit after a play like this has moved out against you. So that's always my first bit of advice. If things are going against you, be as conservative with these strikes as possible, meaning sell as close to the break-even price as you can, because it's one thing if it moves against you off the bat, but you do not want to be caught with your pants down if there's a further move against you, and then you are really out of luck, unable to sell strikes that are anywhere near your cost basis. So I would definitely suggest starting out with those 21s. Maybe let's take a look at the implied volatility on a weekly basis. July 30th looks like it has a lot of IV in it. It's interesting. I can maybe only assume that their earnings are going to be that week, but let's take a look at maybe if we go 1 week further out to July 2nd, see if we get any better premiums. Honestly, not enough to be worth doing anything crazy in my opinion. So I think, my suggestion, if that were me, I'd be going in on those 21 strike calls come market open on Monday, hoping to get around 25 cents for those. And then just, again, take it on a week-to-week basis. Patience is going to win out in the end because, on a week-to-week basis, you could always decrease your break-even price, but the stock can't go down forever. We got another comment in the YouTube chat from Stockboy7254. And if, a guy makes his username Stockboy, he's all about the market. So we've got to answer this one. Any plan on selling cash secured puts this week, between Tesla, Visa, etc.? Now, Tesla's an interesting one. This will be a good segue into this quick scan conversation. Let's see what I'm looking for here. I need to pull up my high put premium scan. Which one of these is it? This is it. Personal high premium. Boom. Let's let it. So again, this scans in the S&P 500, and typically what we see is Tesla at the top of this thing every single week, and there it is, right? We've got Tesla at the 3, 4, and 5 spot because the premium on it is super high, right? From an ROR perspective, that's really, really solid, and some of the best in the S&P 500. Where to go there? Yeah, I have this thing, set to sort by return on risk. I feel like it doesn't always sort by return on risk, so that's one we might just have to manually sort that. But to the point, right? You might be wondering in the back of your head, be a very valid question for the scan is like, hey, these things are offering good return on risk from the S&P 500 on a week-to-week basis. But, what if that's because of earnings? And one of our filters is that it does not have earnings in the next 10 days. So you can be confident that everything you see on here is pure premium. Now, likely it's either due to insane volatility or some other non-earnings related news event that's going to be upcoming. So always important to keep that in mind. And then again, look at the bid-ask spreads, right? Because USB is listed at the top right here, but the bid-ask spread is 21 cents and $3.45. So you seem very unlikely to get a fill on something like that. APA has a little bit tighter of a spread, so we can take a peek at that. APA Corporation, no idea what this thing is. Take a look at the fundamentals tab. APA, it's going to tell me it is an energy holding company. All right. You can see the ranges from 65 down to 418 up to 20. This is, I think if we back this up, we're going to see something we don't like, and that's right. This thing's basically tripled in the last 180 days, which at a high level would rule that out for me in the context of our strategy. But let's take a look at that Tesla chart because that was something we had mentioned in the YouTube chat, and something interesting we could talk about quickly because I'm a huge Tesla bear. I do not think that, it's anywhere near fairly valued right now. I think somewhere in this low 400 range is a little bit fairer. So that personally is where I'm going to be waiting for it to come back down to, because again, if you start small, start zooming out as far as time frame on the chart, you'll start to see it more and more. And yes, Tesla has had a great run and has had some really solid growth as a company, expanding just beyond cars and a bunch of different industries and seeing really solid sales growth. And we don't disagree on the fact that Tesla is a good company. The question for investing purposes lies in the fact of whether or not Tesla is at a good valuation. So, it's one of those things to, I guess, have a quick segue into a different conversation. I see so many people on social media talk about GameStop and AMC saying, oh, it's at 60 right now, but movie theaters are about to open back up, which is good for the company, which means the stock's going to go up. Just because a company does well doesn't mean the stock is going to go up. Especially, this is a very extreme case with AMC where, this company is trading far beyond any value that has any business trading at, right? They were able to offer shares for sale during this squeeze that they received an amount of cash that was essentially the value of their company back in January. So from that perspective, that's an insane and an awesome by management on their part to be able to pull that off. And I know a lot of people who are all in on the AMC squeeze theory weren't too happy about the dilution, but it's kind of a no-brainer from management's perspective. But the thing is, fundamentals, while AMC could keep running up for the next month or two and hit 4 and then come back down, in the end, fundamentals I think are going to win out, and you'll see this thing level off back down around this area. But that circles back to the point I'm making originally where, just because you think Tesla's a good company, just because you think AMC is a good company and things are going to go well in the future, doesn't necessarily equate to an increase in stock price if the current price is overvalued. And that's what I think is the situation that we're in with Tesla. Again, I think this 400 level is a little bit more reasonable for reasons that I'm not going to completely go into on the stream right here. But and again, I've already said this on the stream, but we don't have to agree on, stock valuation and where we think a stock is going to go. However, if you, the only thing we need to agree on is the best way to play it. So if you are bullish on Tesla, perfectly valid opinion to have. Let's take a look at what you could do from an options perspective. And in ROR, you get a really nice weekly return, right? If you wanted to sell 610 puts, that's a 1.61% return on risk. With that margin consideration, I don't think they give you actually too much margin privilege on Tesla. Let me check that out really quickly, where normally your max loss would be 60-40, your buying power effect here would be 23 grand. So it looks like they give you about a third. So multiply that by 3 roughly, and that's what your actual ROC would be. So roughly 4.5%, which again isn't too bad for a week. But, is it bad when considering the downside potential? If you sell a 610 put for $10 a premium, we know that break-even price would put you right at $600. Let's take a look at the price action in the past month. And $600, obviously this is a weekly put, so, maybe looking at the price action over the last month might be a little bit disingenuous. However, again, I do think it's important to at least look in the last month for, formulating expectations about stock activity and stock price in the near future. But, a break-even price right here on a 5-day trade for Tesla would scare me a little bit because, it's a red candle central for Tesla, right? If you go back to that month-long chart, this really isn't, okay, good pronunciation there. This really isn't that long of a period. This is just one trading month, right? And we see big red candles. We see big red candles, big red candle, big red candle, big red candle. We see like 3, 4, 5 instances of big downward movements in the stock. So if Tesla is one that you wanted to sell cash secured puts on, again, I'm not going to stop you. However, I think blindly just waiting until market open on Monday and entering is not the way to go. Waiting for what seems like an inevitable opportunity during the week with these big red candles is going to be the way to do it going forward. And you can see the futures again right here. They're trending downwards even further, minus 0.45%. And it's only 10 p.m., so who knows what the morning will bring. We could see a ton of opportunity as we head into this upcoming week, even just at open tomorrow morning. So that'll be an interesting thing to look at. And then we're kind of over an hour here, so I'm trying to wrap it up relatively quickly, we do have one final question from Prinsmeister in the Twitch chat saying, what's our approach to the weekly SPX hedge going to be like now that the market seems to be in a downtrend? So, initial answer to that question is we're probably just going to keep sticking with it's going to cash in a lot more easily if we continue this downtrend. But as of right now, something that's interesting is, you look at the past few weeks in our account, we've got this indicated as a hedge by the orange highlights. We've had a hedge almost every single week this year. However, I think it's important to take a step back and, think about what is a hedge, right? It's something that you can derive profit from in the event that the market pulls back and, screws over your other positions. Right now, we don't have a ton of super decidedly bullish short-term positions, right? We've got CRSR, which has demonstrated it's a little bit detached from the overall market. We've got PSTH, which we're being pretty conservative with, and as being a SPAC, it's kind of near its net asset value, so I don't think we have a ton of immediate short-term downside risk on that one. And then UWMC and SoFi are so far out in the future that we don't need to have some sort of immediate SPX hedge. So when you have a hedge like this for SPX, make sure you have positions that week that are short-term that you'll benefit from covering in case the market goes down. Right now, I don't think we have anything that would screw us too badly if the market took a big pullback, so I don't currently have an SPX hedge. And that's not to say that I don't think the market's going to go down. I mean, I sometimes, admittedly, always think the market is gonna go down. But I'll definitely wait until I enter into some of those longer-term cash-secured put long positions to implement that SPX hedge. But to your point, as far as the treatment, just keep it simple. Do what you've always been doing. Hedge a similar percent of your account every single week. You don't need to adjust it and the market's going down, we're going to double up on our hedge, because at that point you're starting to toe the line of making it a directional play as opposed to just being a relatively low stress hedge for you. So that is my 2 cents on the SPX hedge. And I realized we didn't really come up with a ton of trade ideas as we head into the week. So I think the best thing I could offer you right now is really stuff that we've already got on the list. We talked about Corsair a little bit, and if you're not already in on it, now's a great time because it's pulled back. It had this huge spike up here, and as you can see, implied volatility was very elevated, and from a base level where it normally trades around this 0.48, 0.5 level, it's still about 40% higher than that, up near 0.7. So there's still a lot of opportunity on implied volatility. And if you look at the 180-day chart, you'll see that we're getting right back into a range of longer-term support here. It's chopped around in this $30 range for a long time, and despite 2 brief dips, it hasn't really been below 30 since last November. So I think at least in the short term, meaning the next month, you can get a lot of value by selling cash secured puts on this thing. So if you wanted to go in on a 30 strike put for $1.10 a premium over the next 4 weeks, obviously the 3.84% ROR isn't huge, but again, you got to take those margin buying power privileges into effect, seeing that you get roughly 3 times that. So a 30 strike put is something that would set you up with a $28.90 break even price on it and give you about a 10% return over the course of a month. And that's a really nice value proposition right there. This gray line I'm hovering over is about where your break even price would be. So I think there's some really solid opportunity as a result, or thanks to this big spike that we had recently on that. And if you want to get a little more aggressive, hell, you're welcome to step up to 32.5 to try to collect a little bit more premium, and you'll see a little bit better return on capital on that one because you'll get a 24.5% return on not 24.5, 24.50 return on what 12.797 of buying power. So while you would need it to run back up a little bit, what I really like about the 32.5 strike puts is the fact that you get a 20% return on capital, and 2, your break-even price is 32.5 minus 250, putting you right at that $30 level for the next 4 weeks, which has been a very, very strong point of support. I think Corsair is a solid company, and you are going to be perfectly fine owning it at 30 going forward. So really, that's kind of a suggestion for the week ahead. SOL is really the only other one I think I'd consider going in on, because Wish, we've played a pretty good volatility spike and drop. We've already but have a unrealized 50% profit on that one, so the opportunity is largely gone on that side of things. SOL is one where you got a little bit better opportunity. It's a solar name that's been beaten down a little bit lately. And I say a little bit, this thing is down a lot from the highs, right? It used to trade at $36 a piece. Admittedly, is a little bit riskier because, this range of 2 to 36 to 8 in the last 180 days isn't, doesn't scream safe blue chip stock. However, this amount of volatility has offered us some really good week-to-week premiums. This is one that has decent volume on a week-to-week basis. So plenty of options out there for you to be able to trade. And the premiums are super, super nice. So you can sell a 7.5 strike put for, 25 cents that week. Give yourself, $7.30 break-even price, which if we look back at the last trading month, right around here, that's the low for the month. So that's a really nice play where on ROR perspective, you're getting, let's see, 7.5, 2.74 a week, which is super, super solid. And that's using 20 cents as the calculation for that. You'll probably be able to get a little bit more than that on Monday morning. But again, a 20% ROC. If you were going to sell this 7.5 strike put for 20 cents a pop, right? While you would, and that's the other thing about this, the margin requirements are beautiful, right? Normally it'd be $7,300 to have this thing fully cash secured, which, still isn't that bad if you wanted to go that route and be super, super safe, because $200 of profit divided by $7,300 of collateral is a 2.7% return. We already see that right there. That's really great on a week-to-week basis. But, if you still wanted to use those margin privileges and use that 961 number that we see right here, I don't know why I did 7 twice, but 961 that we see right here, you're actually getting a 20% weekly return on capital as it lays out right there. So that is a, super, super interesting play. And the other thing about this is stocks that are this wild, I should probably back up to the 180 when I say that. Stocks that are normally this wild, tend to be a little bit more disconnected from the overall market. So if we saw a pretty big dip in the S&P 500, you could potentially find yourself being a little bit safer having your money in something like this with the smaller position, as opposed to, having like an app. You look at the S&P 500, a little bit more correlated, but still not entirely correlated because there was a pretty big tech sell-off earlier this year. But, hell of a lot more correlated than something like an SOL, which is just doing whatever the hell it wants to do. But we've now caught it back in a decent area of longer-term support and have an opportunity to get some decent premium combined with really nice margin buying power privileges on that one. So that would be, between Corsair and Renesola are kind of my two picks. And really, like I've said, I think this week, more than any other week so far this year, is going to be a, day-to-day, hour-to-hour, minute-by-minute evaluation of the market. And we're really going to have to pick and choose our spots. We keep the whole watch list right here. I'm going to keep my eye on that. And if something presents itself to me as an opportunity, that's when I'll jump. And if you guys are in the Discord server, well, if you're not in the Discord server, definitely join. It's all 100% free, and you can see all the trades that we make. We alert them as we make them and talk through our strategies with you guys and try to help you guys out with anything that you might be having trouble with. But for those of you who are in a Discord server, we'll definitely be lighting up that HT Trades channel this week, because we're going to have what I anticipate to be a decent amount of activity, just due to the fact that we have a lot of buying power and there should be a lot of volatility in the market, lending itself to a really, really nice opportunity for us this week. I think we've got a really nice setup. I'm super excited about it. I think we are going to be able to combat another big down week in the market with some profit. And if we can combat two big dips in the market, I'm going to be incredibly thrilled. And that'll really give us, you think we've got some clearance right now between ourselves and the market overall in the year. That's going to be even wider if we're able to fend off another down week in the market. So that is kind of my spiel for the week, I guess. Those are my recommendations. Definitely move forward with caution. Pick and choose your spots. Keep it locked on the Discord, because we're going to be announcing those trades and those trade ideas. It's not always just necessarily, hey, I made this trade, blah, 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 blah. It's going to be, the development of, hey, I see this stock is at this price level. It's got this support. If it goes a little bit lower, I might jump in. And there'll be hopefully a little bit of a lead up to what I'm explaining when I eventually enter into trades this week. So keep it locked on that. Again, appreciate everyone who tuned in with us tonight. We'd love to do this every single week. And again, hopefully we could be talking to you next week from another another really nice week of profit. But that is all we've got for tonight, just over the hour mark. We're going to wrap it up with the way we always do, by saying thanks for watching. This has been the Hourglass Trader, where as time passes, we make money. Thanks again to everyone who has been tuning in with us every single week. I really, really, really appreciate it. And to everyone who's been super active in the chat, in our Discord server, you guys are awesome, and you are making it super useful and really are helping make it the community that it is. And I'm trying my best to grow it each and every single week. So if you've got friends, people you know, people you don't know that you want to help join into our Discord server, I think, there's strength in numbers with what we're doing, putting a bunch of different heads together, because, obviously a few of us can't be watching every single stock in the market. So it helps a ton to have as many minds in the Discord server as we can. It does not cost me a single dollar to help you guys make one. We could all win together, and that's what I want to see moving forward. So thank you guys who have tuned in tonight. We are going to sign off right now, and hopefully we will see you in the Discord server this week and again on the stream next week. Thank you, thank you, thank you guys.